Hello everyone, welcome back to Intellectual Media, the channel where we will explore business, finance, academic knowledge in a simple and practical way. I am happy to have you here today. In this session, we will dive into a very important topic in accounting, which is account receivable. Whether you are a student or a professional or someone learning accounting for the first time, this presentation will help you understand what receivables are, why they matter, and how companies record them with real examples and journal entries. So make sure you stay tuned and take notes, and let's grow our knowledge together. Let's begin. What is account receivable? So receivable means claims held against customers and others for money, goods, and service. So receivable means there is oral promise of purchasers to pay for goods and service sold. So receivable also classified into two. There is account receivable and notes receivable. There is account receivable and notes receivable. When account receivable means there is an amount owed to the business by customers or other parties as a result of selling goods or service on credit. So they are reported as a current asset on the balance sheet. So there are two types of receivables. Under here there is account receivable and notes receivable. When account receivable also called trade receivable. So account receivable means arise from credit sales of goods or service or oral promise of a purchaser to pay for goods and service for sold. So account receivable also usually collected within 30 up to 90 days. So no formal written promise also in account receivable. Whereas in notes receivable, there is a written promise to pay a certain sum of money on a specific future date. And or there is a formal written promise to pay, or there is a promissory note. So usually includes interest in notes receivable. There is an interest, and it can be a short term or long term. The notes receivable also there is can be a short term or a long term. And there is another other receivables also included under the receivables. So there is interest receivable, rent receivable, staff loans or advance, tax refund receivable, insurance claims receivable. Those are other types of receivables. So how to recognize those receivables? So receivable is recognized when the company sells goods or service on credit. When a company that can sells goods and service within a service with on credit and ownership has been transferred. There is an ownership, the transfer of ownership becomes transferred, there is a receivable becomes recognized, and there is a collection is there is probable. There is some collection becomes there is a probable, so receivables becomes recognized. There is a measurement of receivables. How to measure receivables? Receivable can be measured with net realizable value. So one account receivable also has non-trade receivables. Among such non-trade receivables, there is advance to officer on employee, advance to subsidiaries, deposits paid to cover potential damage or loss, or deposits paid as a guarantee for performance, or payment, or dividend and interest receivables. Those are other non-trade receivables. And there is claims against insurance companies for causality sustained and defending under suit. And there is a common care for damage or lost goods, and there is creditors for returned and damaged or lost goods. Those are claims against non-trade receivables. Those receivables. So any recognition of account receivables, or someone becomes sales goods and service on credit, and there's a transfer of ownership. So there is a trade discount between recognition of account receivable. Their measurement becomes net realizable value. So there is a trade discount. So trade discount uses to avoid frequent changes in catalog, like that of reduce from the list price. There is reduce from list price. So the trade discount is very fundamental to reduce from the list, and also alter price for different quantities purchased, and there is head for true invoice price for competence. Is also trade discount is very fundamental. Trade discount is very fundamental. It is very essential, very essential. That means in a trade discount, someone becomes discount there is some certain percent for new retail store customers. So there is an agreement between those. So there is an explanation for recognition of those account receivables. This slides are done described in cash discounts, also called sales discount or trade discount. So how they relate to the account received, there is cash discount or sales discount. So those are price reduction for offered by sellers to encourage buyers to pay early. Those has its own purpose. The first purpose becomes there is improved cash collection. There is improved cash collection, reduce risk for bad debts, and reward customers for early payment. Those are a trade discount. So there is a common discounter. There is a common discounter. Just explains on the slide. This one is there is a cash discount and there is a common sales discount. They offer to introduce prompt payment, and the terms becomes 2/10 n/30. Those are expressed. So 2% means discount if customers pay within 10 days. If the customer pays within 10 days, there is 2% discount. And otherwise, the full amount, net amount is due to in 30 days. ስለዚህ አንድ ሰው በ10 ቀን ውስጥ የሚመልስ ከሆነ 2% ይቀነስለታል። በ30 ቀን ከሆነ ግን ሙሉውን የሚከፍልበት ነው። ስለዚህ 2/10 end of the month. At the end of the month, that means 2% discount if paid within 10 days. Counting starts end of the month. So net 30 means at the end of the month. So full amount of due within 30 days after the end of the month. So after the end of the month, yes. Why those terms become very essential matter. So when recording receivables, accounting must consider those discounts because customers may pay either within the discount period or after the discount period. So the revenue recording can change depending on their method used. Those method is either gross method or net method. So gross method means there is a record the sale of at full invoice price. There is record the sales at full invoice price. If a customer takes a discount, record discount later as a sales discount. So there is a gross method. For example, the sale amount becomes there is $1,000 in terms to 2/10 n/30. The customer pays within the discount period. So entry at the sale. So account receivable becomes in the debit side 1,000, and there is sales revenue is 1,000. So those entry when customer pays within 10 days. So this 10 days. 10 days. So there is a cash, so there is a cash amount, and there is a sales discount, and there is an account receivable can be determined under those transactions or journal entry. So net method means assume the customer will take discount, record sale at net amount. For example, net method assume the amount of sale becomes 1,000 and 2% discount, so the net becomes there is 980. So account receivable there is 980 and revenue becomes 980. If the customer fails to take discount, so there is a reverse. So cash becomes 10,000, account receivable becomes 980, and their sales discount forfeited becomes 20. So cash discounts motive customers to pay early and takes to 2/10 n/30 explain when discounts apply. And those two accounting methods exist. That can be that gross method record full amount, and there is a net method record discounted amounts or record discounted amount. Assume there is an example. So sales amount is 10,000 terms of 2/10. That means there is 2% becomes in counter sale becomes 9,800, and sales revenue also 9,000, and the payment of 4,000 sales received within discount period. So within 10 days become also deducted within such 10%. 2%, and there is a payment of also 6,000 sales received after discount period also under here. There is its own calculation, so it's own calculation, so practice it. So it's on practice it. So it's on practice it. There is some transactions that can be. So there is also its own methods that can be explained under such example, which is on June 30, Bolton company also accurate company also records a merchant having a sale price of 2000, with terms of 2/10 and 60. So uh, on June 12, the company received a check for the balance due from Arcade Company. So prepare the journal entries on Bolton Company bookstore, record the sale assuming Bolton records the sales using the gross method. So based on this gross method, so there is a brief explanation for this question, the recognition of account receivable. So during this illustration, show how Bolton Company records a credit sale using net method, gross method, net method. So the transaction details the date of sale, which is June 3, and the customer becomes Arcade Company. Sale amount 2000 pound. Credit terms 2/10 and 60. So 2% discount if paid within 10 days and the full amount due in 60 days. ስለዚህ በ10 ቀን ውስጥ ከመለሰ 2% ዲስካውንት ያደርጋል ነው። በ60 ቀን ከመለሰ ግን ሙሉን ይከፍላል ነው። ሶ ሺፒንግ ተርምስ ፎብ ሺፒንግ ፖይንት ነው። ሶ ፓይመንት ዴት ጁላይ 29 ሌት ፓይመንት የመጨረሻው ጁላይ 29 ነው። ሶ ዜር ኢዝ ኤ ኪው ኮንሴፕት አንደር ዚስ ኔት ሜተድ። ሶ under the net method, the seller assumes the customer will take the discount. So the sales is recorded net discount. That means 2000 times 2%, which is 40. So 2000 minus 40, which is 1960. There is a net sales. So how to record those journal entries? Record the sales needs. Those company assume market will take 2% discount. There is account receivable 2000 and sales revenue 2000. So in June 12 there is account receivable which is 1960, and also there is a revenue also there is 1000 or sales discount which is 40, and there is account receivable 2000. There is balanced. So customer does not pay, no entry, because customer did not pay within the discount period. So customer pay after discount period, then Arcade full price for $2000 because the discount becomes expired. The discount becomes that means 40 pound is an extra income to Bolton because the customer failed to take the discount. So sale record using those net method assume discount taken, the customer paid late, so discount becomes expired. So the discount becomes expired. So the discount becomes expired. So the discount becomes expired. And there is on the next account receivable. So how those account presented on the statement of financial position. In the statement of financial position, there is an account represented with the beginning and ending balance. Between those accounts within their beginning and ending balance at the debit and credit side becomes determined under here. Determines under here. So there is more preferential regarding account receivables. So there is its own statement of financial position. That means current asset, inventory, prepaid expense, account receivable, less allowance for doubtful accounts, and what the total expressed under here. Those statements before show their financial position, because we will discuss about what do you mean allowance for doubtful accounts. So allowance, what do you mean allowance for doubtful accounts? So allowance for doubtful account or bad debt means there is some customers may not pay. There is 1000. So during account receivable, someone cannot be paid such amount, so some customers may not pay. This expected and collectible amount is called bad debt. So there are two main methods within the bad debt. So the first, there is a cash discount and there is a common sales discount. They offer to introduce prompt payment, and the terms becomes 2/10 n/30. Those are expressed. So 2% means discount if customers pay within 10 days. If the customer pays within 10 days, there is 2% discount, and otherwise the full amount, net amount is due to in 30 days. ስለዚህ አንድ ሰው በ10 ቀን ውስጥ የሚመልስ ከሆነ 2% ይቀነስለታል። በ30 ቀን ከሆነ ግን ሙሉውን የሚከፍልበት ነው። ስለዚህ 2/10 end of the month, at the end of the month, that means 2% discount if paid within 10 days. Counting starts end of the month. So net 30 means at the end of the month, so full amount of due within 30 days after the end of the month. So in direct of method, there is no matching, theoretical deficient, no matching, and receivable not stated at cash realizable value. IFRS not appropriate when amounts and collectible is material. But in the allowance method, there is a percentage of sales and a percentage of receivables. IFRS required when bad debt are material in the amount. So there is a percentage of sales. There is sales becomes there is bad debt expense, and the percentage of receivables, the account received become allowance for debtful accounts. So the percentage of sales pays result in better matching for expense with revenues. So there is more emphasis on income statement relationship, and there is percentage for receivable also more emphasis on statement of financial position or balance sheet. Their percentage of receivable base produce better estimate for their cash realizable. So the percentage of sales approach has, there is percentage based upon past experience. For the past, there is an anticipate credit policy, and also there is achieve a better matching for cost and revenue, and also any balance in allowance for debtful account becomes there is an ignored. So there is has its own illustration. So this illustration is more preferential for practicable. So let us leave it and or jump it, and there is we'll discuss about termination for allowance methods. The percentage of receivables or approach means no matching for estimate for those receivable realizable value. Companies may apply for those method using one composite rate or a gaining schedule for using different rates. There is different rates for in order to determine or recording those amounts. There is a bad debt expense and for allowance for debtful account, allowance for the debtful. So on journal entry and how to record those journal entry with debit and credit. But within illustration, we will see in the next for the discount becomes expired. So the discount becomes expired. And there is on the next we will see about certain period of time. There is also more preferential. So notes receivable also there is another type. There is support for a promissory note for long period of time. There is a negotiable instrument and make signs in favor for pay, and there is zero interest bearing or interest included in a face amount becomes there is not receivable. So not receivable generally originate from customers who need to extend payment period of an outstanding receivable, and high risk or new customers become exist. Loans to employee and subsidiaries or sale of property, plant, equipment, lending transaction. Those majority of notes becomes there is not receivable and originate from those notes receivable that can be recognized with short term and long term. Within a short term, there is a record at face value, less allowance, and there is a long term record at their present value for cash expected to be collected. There is a cash expected to collect becomes very essential under long term notes receivable. So interest rate, stated rate, market rate, there is a face value, and stated rate greater than market rate, there is a premium, and stated rate less than market rate, there is a. So notes receivable for property, goods, service, and that can be any transaction for their miscellaneous and stated interest rate was perceived to be fair unless there is no interest rate that can be stated, and the stated interest rate is unreasonable and their face amount of the note is materially different from current cash sales price and from the current market value of debt instrument. So has its own valuations. There is has its own valuation. There is either short term or long, and their value for special issues. There is also some special issues becomes exist, but short and precise wise there is uh, its own management. So internal control for those over receivables. There is how to control those internal receivables. There is a credit approval system. So there is a credit approval system becomes prepared, and there is aging schedule review becomes determined, and limit for credit customers. There is limit for credit customer, regular follow-up for overdue accounts, and segregation of duties or recording versus collecting. Those are internal control for over receivers. Internal control for receivables, those are all about receivables and receivables. So someone has any doubt, comment. So if you are new for here, uh, any special attention for this, any doubt you can ask and put within a comment. For the next there is some special issues, and there is how to recording allowance for doubtful account or write off. We will discuss in the next, but if you now today we will finish at this. So if you we are if you are new here, don't forget it, like, share and subscribe to Intellectual India for more educational content. Thank you so much. Have a nice time.